I'm Charlotte McLeod with the Investing News Network, and here today with me is Dr. Nomi Prins, investigative journalist, best-selling author, and geopolitical financial expert. Thank you so much for joining me today. Great to have you.
Yeah, thank you so much.
Yeah, and great to have you in person as well. We should mention that we're at the Rural Symposium down in Florida. I wondered if we could start just by kind of gauging your sense of sentiment down on the show floor.
Yeah, that's a great question. And of course, it's so nice to be back with so many experts on everything from the economy to mining to commodities in one space. That's really nice. We all feel that, and I think that speaks to the sentiment. I think everybody's very positive about just being able to join each other, and also very engaged. There's a lot of volatility going on in the market right now. There's a lot of uncertainty, there's fears, and I think the sentiment is that we really want to sort of diagnose why and what, how long it's going to last, and what we can do on the other side.
Right, and those are tough questions to answer. And I've been saying this to many people, but this event is kind of coming at a great time. We had the Fed meeting this week. We got our hike of 75 basis points, as was widely expected. There's been so much discussion around what's going on. I wondered if you have seen anything from that meeting or the press conference that you think people might be missing.
Well, what I think is really interesting is the verbiage that was used into that press conference and during that press conference, and what Powell addressed and what he didn't address. So of course we got the 75 basis points. That was expected, as you said, and as the market predicted. I don't think we're going to have another hike that high. I think at this point, inflation will continue to still be a persistent factor for a lot of different reasons that aren't controllable by the Fed. But I don't think we're going to see the same sort of size of rate hikes, and that's because of something in particular that Powell said before the conference and the press conference and after, which is that he was talking about the softening, and he used the term softening of consumption, consumer consumption, and production. And what that means is he's starting, or the Fed's starting to see or aggregate or at least talk about seeing signs that what they are doing is actually having an impact. And that's even with the recent inflation CPI figure at 9.1, core inflation at 5.9, and a lot of that's related to energy, even when you take out energy. So a lot of that 5.9% still has to do with transportation and medicine, hospitals, all of which rely on energy costs and are basically inflated by high energy costs. So there's all of that going in behind the scenes, and the Fed was starting to address softening. And to me, that's them starting to signal a sort of victory lap against inflation. Now, have they actually impacted inflation? No. A, it's still high, and B, a lot of it is still, again, connected to energy prices and food prices and shelter prices. But that language indicates them wanting to pivot and to find a way to do that makes them seem like they have been effective.
Right, so you mentioned the verbiage, and it's amazing to me that we have to look so deeply and carefully at these statements, whether it's in the press conference or statements from the meetings. You've been following all of this for quite some time. Is this something that's new that we're starting to do more, or has it always been like this?
It always has been. I remember back in the day when I was working on the trading floor at Lehman Brothers, when Lehman Brothers still existed. And we would stand there, and we didn't have 24/7 news, so a lot of stuff came across the ticker, and Bloomberg terminals, not Bloomberg News, because there wasn't Bloomberg News. And there would be this, everybody stops and waits to see what the Fed's going to do and what Alan Greenspan's going to say, and so forth, and then discuss it. So that element of trying to parse what's going on and what it means, that's not new. What we do have now is way more coverage, way more opinions, way more noise, and a Fed that's also very diffuse in terms of its messaging sometimes itself, which is that you have Powell, but you also have a lot of different Fed leaders across the 12 Federal Reserve banks, and you get a lot of just noise because of that in terms of both messaging and what we're supposed to get from it. And also, I don't really think the Fed knows what it's doing half the time, and so the maybe more than half the time. But so the messaging is meant to be flexible. It's meant to give them room to pivot to either side. So when Powell said the other day that he's going to, start to look at data and risks, what he was saying, risks and data. Well, what that means is that could go either way. So the market can decide to interpret that as, well, risk to the upside of inflation, or it can choose to interpret it as risk to the downside of the economy. And the Fed is specifically vague in order to allow it to basically do whatever it needs to do or wants to do at any moment. And I think that aspect has always been around. It's just we've got more people talking about it as 24/7 and dissecting it now than we've ever had before.
Right, and on the note of the Fed and Jerome Powell being vague, we had the persistent questioning yesterday on are we in a recession, which he ultimately told us no. We've got our GDP data today. Is that really even a question we should be asking him?
Well, because the Fed is technically supposed to be looking at two parts of the economy. It can't control the economy. Again, it can't mine for commodities, it can't drill for oil, it can't produce and farm food. There's a lot of things the Fed can't do which are part of inflation, which it has no control over. It has control over monetary inflation. It has control over growing the size of its book, which currently is at $8.87 trillion. It's very big. It's only been reduced by $9 billion out of $8.87 trillion in the past 2 months. That was another question that he dodged when he was asked about the book. So there's two big dodges here. There is the dodge about are we really in a recession? Well, technically we are. We've had 2 consecutive quarters of a decline in GDP. By classic economic standards, that defines a recession. We also have a situation where wages have not kept up with inflation. That's going to create more weakness in the economy because people just don't have the money to spend on what things cost. So there's a lot of things like that that the Fed actually cannot control. And that's one of the reasons I think he tries to sidestep that as much as possible until it's right in his face and he has to have an answer. And again, it's the same thing with just dodging the question about his book, which was this tiny question that one of the reporters put in there at the press conference, and which he just didn't even address at all. He just went on to something else because they have not come through on the promise of really reducing their book relative to what they said they would reduce it by at this time. I think that's because they're trying to basically play on both sides of the fence in terms of monetary policy. They have raised rates. Again, I don't think they're going to raise by 75 again. I think it's going to come down from there and eventually neutralize. But they've also not really reduced the book as they said.
Right, and speaking about inflation here at the symposium, I believe this morning you were on a panel about how to tame inflation. So interested to hear about that, particularly, these factors that are pushing inflation that are beyond the Fed's control.
Well, and that's exactly it. There's a very limited amount of inflation that the Fed can control. And it can't control the headline components of headline inflation, which are food and energy. And it cannot control what's behind or beneath those headline figures, even in core CPI, like transportation, like hospital costs, like medical costs, like moving pharmaceuticals from one place to another, because all of that requires fuel, and all of that is impacted by the price of fuel and by energy. So a lot of CPI is connected to something the Fed absolutely has no control over. Where it has a little bit of an impact is on housing and is on rent, both of which are also in the CPI. The thing is, by raising rates, they can temper the housing market in terms of sales. And in terms of the price of those sales. And we have seen those numbers come down a bit. That's positive for inflation coming down. However, on the other side of that, rents go up because less people can buy new homes, and because the people that have bought homes, or the companies like BlackRock as a private equity company, which has bought a lot of homes and then rents them out, has the ability to increase those rents because people need a place to live. And that stretches the inflationary impact of rents. So what the Fed is doing by raising rates is it's exacerbating that gap between rents rising and, yes, houses coming down, but that creates a problem for the general economy, and specifically for workers who can't afford rent, or for whom, as we have now, 20% of American families pay 60% of their paycheck on food, shelter, and fuel. And so that, again, that will create a constriction in consumption, again, backdoor related to the impact of the Fed raising rates. But the other stuff it can't really control.
Right, and starting to talk about the impact on families, I think a lot of people who are here at the symposium are wondering, what can I do? How can I protect myself, preserve my wealth? Where can they start?
So I think the number one thing, if you're an investor, which a lot of the people at this conference are in different modes, and of course there's a big focus on natural resources, and that connects into energy and this component of the economy, there's a couple things that investors do and should not do relative to when markets are this volatile and uncertain, which they are because they're trying to figure out what the price of money will really be, what the Fed will really do, and also globally what other central banks are doing around the world, which is they're not acting as aggressively on raising rates as the Fed is, or where they are, they're still keeping their book of bonds. In other words, they're still keeping money out there from their prior QE activity to cushion their market. So that's happening. People can stick to their positions. If they have seen quality companies, for example, quality mining companies, like Fremont McMoran, FCX out in Arizona, who's had to close one of their mines because copper prices have come down during this uncertain period, and on talk of global growth slowing down and so forth, it takes more money and it takes longer to open a mine than it takes to close it. So as long as the demand for construction that relates to copper still exists, and that's predominant in the energy sector, in the new energy sector, we have a situation where they will have to come back online. It will take a while, and that's going to push the price of copper back up, and that's going to push their stock back up. So there's certain examples like that all over the place where if people have investments, they should hold them. They should not sell it at a loss, and they should just literally not look at their portfolios. I mean, that's like the number one thing to do. Unless it's a company that's legitimately going bankrupt for other reasons and there's specific elements impacting it beyond the overall uncertain situation, they should stick in there. They should also consider buying these dips and not worry about whether they're timing the dips right. Because no one can do that. We just can't. Anyone who says they can, they're just lying. You can't. But what you can do is you can have a strategy that wades in. And I like to think of a strategy as being a 10-to-1 strategy, where if you have, say, $1,000 that you have on the side to invest, and you have a portfolio of good stocks already, and a lot of them are down, let's say right now, that you do 100, 100, 100, 100, maybe that's once a week, maybe that's once every 2 weeks during this period, you might not get the perfect dip, you might miss the bounce. But what you're doing is you're solidifying the base of that investment for your portfolio. And the same thing goes with commodities. We've seen gold pretty much stick in there, but it has come down. But that's another situation where you can leg in that investment into gold. Silver is another perfect example. It lags gold both on the upside and the downside, but it's far cheaper. But it's used in electricity development, it's used in new energy, it's used for production purposes to be more carbon neutral and efficient. And it's also going to have a bid up when we get out of this period of uncertainty. And so that's a place to invest. Copper, a place to invest. All of these places you leg in. And that ultimately will prove to solidify your wealth, your portfolio, and not expose you to taking losses. You just don't need to take just because the market is, just because there's technical selling on the back of the market going down. The regular retail investor who wants to protect their wealth and their family's wealth should literally ignore all of that. Doesn't happen. It's hard to do. It's hard. But that's what needs to be done.
Okay, and so when you're talking about this new energy story, right, we've got copper, we've got silver, are you also including in that things like lithium and cobalt?
Yes.
Okay.
Yeah, I'm glad you asked that, because there's a couple things with lithium, with cobalt, with nickel that all come together, right? One is supply chain problems. You know, we have a lot of nickel in the Ukraine-Russia conflict war that's going on right now that has basically stuck in there because of that. But we also have development in things like Greenland and Iceland where we're looking at new minerals coming out. But we also have this geopolitical pivot to wanting to source domestically certain rare earth minerals, certain metals, and so forth. And lithium comes into that. So we have lithium as a needed material for EV batteries. We also have a geopolitical focus, and that's both on the Republican and the Democrat side. I mean, it's come out through President Biden because he's in the White House right now. But it's a bipartisan concept that we want to have the ability to mine our own rare earth minerals. And there's only a few places in the United States and in North America, throughout Canada and so forth, that can do that. And that's why lithium is both scarce, but also the demand is growing, and companies in this part of the world, because of the geopolitical pivot, will see an upside, and that will see an upside, because we are going EV. Like almost everywhere there's a backlog in EVs. You know, I checked my dealer for the car I have, it's 3 years to wait for an EV. And I'm not alone. So what we've seen in this fuel crunch up in terms of prices is that there is more and more of a need to pivot to electric vehicles and electrification of production throughout. Amazon, for example, they're opening plants throughout the middle of the country, and they're putting in charging stations for Rivians, right? Because they need to find a way to more cheaply, more effectively, more economically get their stuff from point A to point B. All of that's going to rely on these rare earth minerals and on the companies that both mine, produce, and create them in the terms of vehicles and transportation. And that's all connected to this idea of new energy.
Right, and you know, I think that governments, including the US, are definitely feeling like we need to bring this inside, and they're presenting these initiatives that will help move forward. But we know that governments tend to move quite slowly. Do you see that speeding up as this becomes more needed?
Well, what governments have been doing is coming to sort of bipartisan agreement or bi-party agreement on sort of seed funding for some of these areas. So in the Bipartisan Infrastructure Act, there was a multi-billion-dollar section for specifically EVs, and then after that there was an executive order signed by President Biden to do things at home where we could in terms of the parts. And so that provides really the seed money. And then after that, you've got private companies coming in, Wall Street coming in and finding those companies and helping to fund those companies. And then they also get government contracts because it's all coming together. So even though the government's not necessarily doing everything, what it is doing is adding another source of funding and a pile-on into an area that's going to grow, that is definitely going to expand no matter who's funding it. And so you do get that pile-on effect.
Perfect. So this has been great. Thank you for going through all those things. Are there any final thoughts you would add for the audience at this very interesting time?
Well, what I did want to do, because I have just written a book on this.
Yes, coming out this fall.
Yes, yeah, that's coming out October 11th, and I mentioned that. It's called Permanent Distortion, How Financial Markets Abandoned the Real Economy Forever. And that's not a light subtitle or title that I came to, and the reason for that is a lot of what we've been talking about today. The Fed and other central banks basically pumped a lot of money into the system over a lot of years and went into overdrive post-COVID, and that distorted asset values, including asset values on commodities relative to our needs in the real economy and where that money is going and is going to go. And so I think it's important, again, to sort of can't underscore, enough that we have to avoid the noise of the markets and the Fed and everything else. Now, look at the bigger picture of a lot of that money still being available to big participants in the market. That permanent distortion being permanent between money coming in and where it goes into the real economy, and those sectors, particularly like new energy, that are still and will benefit from that distortion. I do talk about all of that in the book, but it's, I think, a very interesting time in our world to, again, forget the noise right now, but just to look at where all this development is going and where all this money is going to flow as a result.
Okay, we're definitely looking forward to the book. Can we pre-order now, I imagine?
Yes, it's available, Amazon, Barnes & Noble, your local bookstore, ordering off the whole 9 yards. So,
perfect.
yeah,
Well, thank you so much for coming on to talk about all these difficult topics. It was great to hear from you.
Thank you so much.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Dr. Nomi Prins.